Hi, this is Rowland from Money and Markets TV. 2011 was officially a flat year for the U.S. stock market. The S&P 500 was down a fraction, and its total return was just 2.1%, including dividends. But the action in the broad index's 10 primary sectors was quite different. Only three sectors, financials, materials, and industrials, had a losing year, and the industrial stocks were off less than 3%. Meanwhile, three other sectors, utilities, consumer staples, and healthcare, posted double-digit gains. So, how did the index end up at break-even? The answer lies in the fact that the S&P 500 is capitalization weighted. Each stock, and therefore each sector, influences the overall index in proportion to its size. If we look at the market capitalization of each sector, the index returns make more sense. One of the largest sectors, financials, had the biggest declines at 18.4%, and the other two biggies, technology and energy, had gains in the low single digits. Conversely, the best performing sectors tended to be smaller. Utilities had a great year, but that group represents only 3.9% of the S&P 500's value. The year's other two big winners, consumer staples and healthcare, are middle-sized. This pair kept the financials from dragging down the whole index. You'll also notice that the winning sectors were those traditionally thought of as being defensive. Utilities, consumer staples, and healthcare are often among the best havens in a weak economy, and that was certainly the case in 2011. About a third of the gain in the utility sectors came in the final 2 weeks of the year, a trend that looks a lot like window dressing to me. That's when portfolio managers pile into the yearly or quarterly winners so their clients will think that they've been in the best stocks all along. But now that 2011 has turned to 2012, interest in the utilities has dried up. The sector lost about 2.5% in the first week of January. Healthcare, on the other hand, has shown much steadier recent results. The SPDR S&P Healthcare ETF actually outperformed its counterpart for the utility sector in the fourth quarter of 2011 by a margin of 10% versus 8.2%. And I suspect healthcare will continue to outperform. If you want to get in on this trend, there are several large diversified healthcare ETFs to choose from, including offerings from SPDR, Vanguard, First Trust, and two from iShares. The bottom line is, not all defensive sectors are always equal. Always remember to do your own due diligence before jumping into any stock or ETF. For Money and Markets TV, I'm Ron Rowland. Thanks for watching.